For decades, silver has lived in the shadow of gold, the overlooked sibling, the industrial workhorse, the metal that never quite captured the imagination of global finance. While gold soared past $2,000 per ounce, cementing its status as the ultimate store of value, silver languished below $50, trapped in a psychological prison of its own making. Investors watched, governments ignored it, central banks dismissed it as irrelevant. But on a seemingly ordinary trading day in 2025, something extraordinary happened. Silver didn't just break through $60 per ounce, it shattered it. The barrier that it held for over a decade, the psychological fortress that traders called the Maginot Line, collapsed in spectacular fashion. Silver reached $61.75, and with that breach came a signal that reverberated through every corner of the global financial system. The soft default has begun. The term Maginot Line is borrowed from history, a reference to the elaborate system of fortifications built by France in the 1930s to protect against German invasion. It was supposed to be impenetrable, a wall of concrete and steel that would hold back any threat. But when World War II erupted, the Germans simply went around it, rendering the entire structure obsolete overnight. The $60 level in silver operated in much the same way, a perceived ceiling, a boundary that market forces had established through years of manipulation, suppression, and systematic undervaluation. Banks, hedge funds, and institutions had spent years engineering silver's price through futures contracts, paper derivatives, and coordinated selling pressure. They built their own Maginot Line, a psychological barrier designed to keep silver contained, predictable, and under control. For years it worked. Silver would approach $60, falter, and retreat. Traders learned to bet against it. Analysts declared it a dead metal. But just like the original Maginot Line, this barrier wasn't breached by a frontal assault. It was bypassed entirely by forces the architects never anticipated. The collapse began not in New York or London, but in the physical markets of Asia, the industrial heartlands of manufacturing, and the sovereign vaults of nations quietly accumulating strategic reserves. While Western institutions played games with paper contracts, real demand was building, a tidal wave of industrial consumption, green energy requirements, solar panel manufacturing, electric vehicle production, and technological advancement that required silver in quantities the market could no longer supply. The numbers tell the story with brutal clarity. Global silver mine production peaked years ago and has been in steady decline. Existing mines are depleting faster than new discoveries can replace them. Recycling efforts, while significant, cannot fill the gap. Meanwhile, demand has exploded. Solar energy alone now consumes more than 100 million ounces of silver annually, and that figure is projected to double within 5 years. Electric vehicles require twice as much silver as traditional combustion engines. 5G infrastructure, semiconductor manufacturing, medical devices, water purification systems, every pillar of the modern economy runs on silver. The deficit between supply and demand has grown into a chasm, and the market, for the first time in decades, is being forced to acknowledge reality. But the breach of $60 is about more than supply and demand fundamentals. It represents something far more profound, a crisis of confidence in the entire architecture of global finance. The soft default that traders now whisper about refers to the growing realization that the paper markets for precious metals have become detached from physical reality. For years, the London Bullion Market Association and the COMEX Futures Exchange have operated on a fractional reserve system, where hundreds of paper claims exist for every physical ounce of silver in storage. This worked as long as investors were content to hold paper promises instead of demanding physical delivery. But that calculus is changing. Investors, burned by years of currency devaluation, negative real interest rates, and reckless monetary policy, are increasingly demanding physical metal. They want bars and vaults, coins and safes, tangible assets they can hold. And when they make those demands, the system is struggling to deliver. Premiums on physical silver have exploded. Delivery delays stretch into months. Mints around the world have been forced to ration production. The paper price and the physical price are diverging, and that divergence is the soft default, the quiet acknowledgement that the system cannot honor all its obligations simultaneously. The psychological impact of $60 being breached cannot be overstated. For over a decade, this level functioned as a governor on market psychology, a ceiling that trained an entire generation of traders to sell at resistance and buy on dips. That pattern has been obliterated. Technical analysts who built careers on chart patterns and historical resistance levels are watching their models fail in real time. Momentum traders who shorted silver at $60 are facing catastrophic losses. Institutional funds that dismissed precious metals as relics of a bygone era are scrambling to reposition. The breach of the Maginot Line has triggered a cascade of stop-loss orders, forced covering of short positions, and a rush of new capital seeking to capture what many now believe is the beginning of a secular bull market in silver that could rival or even exceed the legendary run of 1979 and 1980, when silver briefly touched $50 before collapsing under the weight of speculative excess and coordinated intervention.
The historical parallels to 1980 are impossible to ignore, yet the current situation differs in critical ways that suggest this rally may have far more staying power than its predecessor. In January 1980, silver reached an all-time high of $50.36 per ounce, driven almost entirely by speculative mania orchestrated by the Hunt brothers, Texas oil billionaires who attempted to corner the global silver market. They accumulated massive positions through futures contracts and physical holdings, creating artificial scarcity that sent prices parabolic. But when regulators intervened, changing margin requirements and trading rules specifically to break their corner, the market collapsed. Silver plummeted from $50 to below $10 within months, leaving a generation of investors burned and skeptical of precious metals for decades. The 1980 spike was a bubble, pure speculation, disconnected from fundamental demand. The current rally is fundamentally different. This time, the driver isn't speculative excess, it's structural deficit, real industrial demand, and a monetary system in crisis. The numbers paint a picture of a market fundamentally out of balance. According to data from the Silver Institute, global silver demand reached approximately 1.2 billion ounces in recent years, while mine production struggles to exceed 800 million ounces annually. That deficit of roughly 400 million ounces has been filled by drawing down above-ground inventories, recycling scrap, and liquidating holdings accumulated during previous decades. But those buffers are exhausting. COMEX silver inventories, which once exceeded 300 million ounces, have been drawn down by nearly half. The eligible silver available for immediate delivery has fallen to levels not seen since the financial crisis of 2008. In London, the traditional epicenter of physical precious metals trading, vault stocks have similarly declined as Asian buyers aggressively purchase and move metal eastward. China and India, the world's two most populous nations, are absorbing silver at record rates. China for industrial manufacturing and strategic reserves, India for jewelry, investment, and cultural traditions that prize physical precious metals as stores of wealth. The green energy revolution has emerged as perhaps the single most significant structural driver of silver demand in human history. Solar photovoltaic panels require approximately 20 grams of silver per panel, primarily in the conductive paste that converts sunlight into electricity. As nations worldwide commit to carbon neutrality targets and renewable energy mandates, solar installations are accelerating at exponential rates. The International Energy Agency projects that solar capacity will triple by 2030, which translates directly into silver consumption of potentially 200 to 300 million ounces per year from solar alone, nearly matching the entire annual deficit from all sources combined. Electric vehicles compound the problem. Each EV requires approximately twice as much silver as a traditional internal combustion vehicle, used in electrical connections, charging systems, battery management, and power electronics. With global EV sales projected to reach tens of millions of units annually within the next decade, and with major economies mandating the phase-out of gasoline vehicles, silver demand from the automotive sector is entering a period of structural growth that has no historical precedent. Yet while demand explodes, supply remains constrained by geological reality. Silver is rarely mined as a primary product. Approximately 70% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means that silver supply is largely dependent on the economics of base metal mining rather than silver prices alone. Even if silver reaches $100 per ounce, new dedicated silver mines take years to develop, require massive capital investment, face increasingly strict environmental regulations, and must contend with declining ore grades as the richest deposits have already been exploited. The days of discovering massive high-grade silver deposits like those that fueled production in the 19th and 20th centuries are effectively over. Modern silver mining is a game of extracting lower concentrations from increasingly complex geological formations, which means production costs rise even as output struggles to keep pace with demand. The monetary dimension adds another layer to silver's renaissance. For millennia, silver functioned as money, arguably more so than gold given its lower value per unit made it practical for everyday transactions. While the modern financial system abandoned precious metals as the basis of currency decades ago, the consequences of that abandonment are becoming increasingly apparent. Central banks worldwide have engaged in unprecedented monetary expansion since the financial crisis of 2008, accelerating dramatically during the pandemic. The Federal Reserve's balance sheet exploded from less than $1 trillion in 2008 to over $9 trillion at its peak. The European Central Bank, Bank of Japan, and People's Bank of China followed similar trajectories. This expansion represents the creation of trillions of dollars worth of currency units backed by nothing but government promises and sovereign debt. For years, this policy seemed to work. Inflation remained subdued, markets rallied, and fears of currency debasement appeared overblown. But the laws of economics cannot be suspended indefinitely, only delayed.
Inflation, dormant for over a decade, has returned with a vengeance. Official consumer price indices, which many economists believe substantially understate real inflation through methodological adjustments and substitution effects, have registered levels not seen since the stagflation crisis of the 1970s. Real interest rates, the difference between nominal interest rates and inflation, have been deeply negated for years, meaning that savers holding cash or bonds are losing purchasing power every single day. This environment has triggered a global search for assets that preserve wealth, stores of value that cannot be printed, diluted, or devalued by central bank policy. Gold has benefited enormously, reaching all-time highs above $2,000. But silver, with its dual nature as both industrial commodity and monetary metal, offers a unique value proposition. It provides exposure to the same monetary debasement concerns that drive gold, while simultaneously offering leverage to real economic growth through industrial demand. This combination is proving irresistible to a new generation of investors who recognize that the $60 barrier wasn't a ceiling, it was merely the floor of the next phase.
The concept of a soft default requires careful examination because it represents a phenomenon that traditional financial analysis struggles to categorize. Unlike a hard default, where a debtor explicitly fails to meet obligations, triggering legal consequences and formal restructuring, a soft default operates in the shadows, a gradual erosion of value and confidence that occurs without official acknowledgement. In the context of precious metals markets, the soft default manifests as the growing inability of paper markets to deliver physical metal at quoted prices. For decades, the price discovery mechanism for gold and silver has been dominated by futures exchanges and over-the-counter derivatives markets, where participants trade contracts representing metal rather than metal itself. The COMEX in New York and the London bullion market operate on fractional reserve principles, where the total notional value of outstanding contracts vastly exceeds the physical inventory available for delivery. Under normal circumstances, this system functions adequately because most participants settle contracts in cash rather than demanding physical delivery. But these are not normal circumstances. The warning signs have been accumulating for years, visible to those paying attention, but dismissed by mainstream financial institutions as aberrations or temporary dislocations. Physical premiums, the difference between the paper spot price and the price required to actually purchase physical coins or bars, began widening significantly during the pandemic. Investors seeking to buy American silver eagles, Canadian maple leafs, or other popular bullion coins discovered they needed to pay $4, $5, even $6 above the spot price. Dealers blamed it on supply chain disruptions, mint capacity constraints, and surging retail demand. But the premiums persisted even as pandemic restrictions eased, suggesting deeper structural problems. Delivery delays stretched from days to weeks to months. The United States Mint periodically suspended sales of certain products due to blank shortages. Private mints worldwide struggled to source sufficient raw material. These aren't symptoms of a well-functioning market. They're symptoms of a market under severe stress, where paper prices have become divorced from physical reality. The divergence between East and West has accelerated this process dramatically. While Western financial institutions continued treating silver primarily as a speculative trading vehicle, Eastern nations recognized its strategic importance and acted accordingly. China, despite being the world's largest silver producer, has become a net importer of the metal, absorbing domestic production and purchasing additional supplies from global markets. The Shanghai Gold Exchange, which also trades silver, has at times quoted prices significantly above Western benchmarks, reflecting genuine physical demand rather than paper speculation. India's import figures tell a similar story. Despite government efforts to curtail gold and silver imports to manage trade deficits, physical demand remains insatiable, driven by cultural traditions, jewelry fabrication, and an inherent distrust of purely fiat currency systems. The flow of physical metal has become decidedly unidirectional, moving from west to east, from vaults in London and New York to private hands in Mumbai and Shanghai. This transfer represents not merely a reallocation of assets, but a fundamental shift in economic power and monetary understanding. The institutional response to silver's breach of $60 reveals the deep discomfort this development has triggered within establishment finance. Mainstream financial media, which spent years dismissing precious metals investors as paranoid gold bugs living in their parents' basements, suddenly found itself scrambling to explain why silver was rallying. The explanations offered were predictably superficial: speculation, momentum trading, retail investor mania, Reddit-fueled short squeezes. What these analyses carefully avoided was any serious examination of the structural deficits, monetary debasement, and derivative market fragility that actually drive the rally. Banks that had maintained substantial short positions in silver futures faced mounting losses as prices climb.
Yet few mainstream outlets discuss the conflict of interest inherent in having the largest commercial banks simultaneously acting as market makers, price setters, and directional speculators. The regulatory agencies that are supposed to ensure fair and orderly markets remained conspicuously silent as premiums widened and delivery delays lengthened, behaviors that in any other market would trigger immediate investigation. The technological dimension of silver's supply crisis deserves particular emphasis because it illustrates how modern civilization has created dependencies on resources it cannot readily replace or expand. Silver's unique properties, the highest electrical and thermal conductivity of any metal, exceptional reflectivity, antibacterial characteristics, and catalytic capabilities, make it irreplaceable in countless applications. Engineers don't use silver because it's cheap or abundant. They use it because nothing else works as well. In electronics, silver enables the miniaturization and performance improvements that define modern devices. The smartphone in your pocket contains approximately half a gram of silver in its circuitry. Multiply that by billions of devices produced annually, and the scale becomes apparent. In medicine, silver's antibacterial properties make it essential for wound dressings, surgical instruments, and medical devices. Water purification systems increasingly rely on silver to eliminate pathogens without the chemical residues of traditional treatments. These applications aren't discretionary luxuries that can be eliminated during shortages. They're fundamental requirements of modern infrastructure. The just-in-time supply chains that characterize modern manufacturing have created a system with minimal redundancy and maximum vulnerability to disruption. Industrial consumers of silver, the electronics manufacturers, solar panel producers, and automotive companies, typically maintain only weeks or months of inventory, relying on continuous supply from refiners and dealers. This approach works brilliantly when supply is reliable and prices are stable, but it becomes catastrophic when supply chains break or prices spike unexpectedly. Companies that budgeted for silver at $25 per ounce in their production planning suddenly face input costs that have more than doubled. They cannot simply pass these costs to consumers without risking market share, yet they cannot eliminate silver from their products without compromising performance or functionality. This creates intense pressure throughout the supply chain as manufacturers compete for limited physical supply, driving premiums higher and creating delivery bottlenecks. The result is a feedback loop where rising prices trigger panic buying, which depletes inventories, which drives prices higher still. A dynamic that bears uncomfortable similarities to the energy crises and commodity supercycles that have periodically destabilized global economies throughout history.
The implications of silver's breach beyond $60 extend far beyond the precious metals market itself, serving as a symptom of broader systemic fragilities that have accumulated within the global financial architecture. For decades, the prevailing orthodoxy in economics and finance held that commodity prices were primarily cyclical phenomena, subject to temporary imbalances between supply and demand, but ultimately mean reverting as markets adjusted. High prices incentivized production and discouraged consumption, while low prices had the opposite effect, creating a self-correcting mechanism that prevented sustained extremes. This framework worked reasonably well in an era of abundant resources, stable monetary policy, and gradual technological change. But the 21st century has shattered these assumptions. Resources are no longer abundant. They're increasingly constrained by geological limits, environmental regulations, and underinvestment. Monetary policy is no longer stable. It's characterized by unprecedented intervention, negative real rates, and explicit currency debasement. Technological change is no longer gradual. It's exponential, creating demand surges that markets cannot anticipate or accommodate. Silver's rally to $61.75 represents the collision of these forces in a single, highly visible market. It's a warning signal, a canary in the coal mine indicating that the gap between financial abstraction and physical reality has grown too wide to sustain. The soft default underway in precious metals markets may be just the beginning of a broader reckoning as other critical commodities, copper, lithium, rare earth elements, even food staples, face similar dynamics of structural deficit and derivative market dysfunction. The financial system has been built on layers of abstraction, each layer further removed from tangible assets and real production. Stocks represent ownership claims on companies. Bonds represent promises of future payment. Derivatives represent bets on the price movements of underlying assets. And increasingly, even those underlying assets exist primarily as electronic entries in databases rather than physical goods in warehouses. This abstraction enabled tremendous growth in financial sophistication and market liquidity, but it also created fragility, a system where confidence and perception matter more than substance, where prices can be manipulated through paper trading, and where the discovery of true scarcity comes as a shock rather than a gradual realization. The historical precedents for what happens when commodity markets experience this kind of breakdown are sobering. The oil shocks of the 1970s demonstrated how quickly supply disruptions in a critical commodity could cascade through entire economies, triggering inflation, recession, and political upheaval. The food price spikes of 2008 and 2011 sparked riots and contributed to the Arab Spring uprisings that toppled governments across North Africa and the Middle East. The energy crisis in Europe following geopolitical tensions has shown how dependency on external suppliers of critical resources can compromise national sovereignty and economic stability. Silver, while less visible than oil or food in everyday life, underpins so much of modern infrastructure that sustained supply shortages or price instability could have comparable impacts. Solar energy deployments could stall, delaying climate transition goals. Electronics manufacturing could face disruptions, affecting everything from consumer devices to military systems. Medical supply chains could experience shortages of critical equipment. The interconnectedness of modern economies means that no commodity exists in isolation. Disruption in one market ripples through countless others. The response of policymakers and central banks to silver's rally will be crucial in determining whether this represents a temporary spike or the beginning of a sustained revaluation. History suggests that authorities typically respond to commodity rallies with some combination of intervention, regulation, and monetary tightening designed to suppress prices and restore stability. In 1980, regulators broke the Hunt brothers' silver corner through rule changes that made their positions untenable. In the 1970s, Federal Reserve Chairman Paul Volcker broke the back of inflation and the commodity supercycle by raising interest rates to levels that triggered deep recession, but ultimately restored price stability. The question now is whether similar measures are feasible or even desirable in the current context. Raising interest rates aggressively would help combat inflation and potentially cool commodity markets, but it would also risk triggering defaults on the massive debt accumulated by governments, corporations, and households over decades of artificially low rates. The global debt-to-GDP ratio has reached levels historically associated with financial crises and sovereign defaults. Servicing this debt becomes exponentially more difficult as rates rise, creating a trap where central banks face a choice between tolerating inflation or triggering financial collapse. The emergence of alternative monetary systems and decentralized finance adds another dimension to silver's resurgence. Bitcoin and other cryptocurrencies have captured enormous attention and capital flows from investors seeking alternatives to fiat currency, but they face fundamental limitations. Cryptocurrencies exist purely as information, requiring constant energy input and network maintenance to preserve value. They cannot be held physically, cannot function without electrical infrastructure, and remain vulnerable to regulatory crackdowns, exchange failures, and technological obsolescence. Precious metals, by contrast, require no maintenance, survive any disaster, and have maintained value across millennia and civilizations. Silver, being more affordable and practical than gold for most individuals, offers a tangible alternative to both fiat currency and digital assets. The growing recognition of this value proposition is drawing capital from multiple directions: investors fleeing negative real yields in bonds, cryptocurrency enthusiasts seeking physical backing for digital tokens, preppers and survivalists building resilience against systemic breakdown, and institutional funds finally acknowledging that real assets may outperform financial assets in an inflationary environment. The psychological transformation occurring in markets deserves emphasis because it represents a shift in consciousness that could prove as significant as the price movement itself. For an entire generation of investors who came of age after the 28 financial crisis, precious metals were relics, old-fashioned stores of value rendered obsolete by modern portfolio theory, central bank omnipotence, and technological innovation. These investors grew up in an era where stocks always recovered, where central banks always backstopped markets, where digital disruption created trillion-dollar companies from nothing, and where physical assets seemed quaint compared to intellectual property and network effects. The breach of $60 in silver, combined with gold's sustained strength, inflation's return, and growing awareness of supply constraints, is forcing a reassessment. Perhaps physical scarcity matters after all. Perhaps central banks aren't omnipotent. Perhaps the monetary experiments of the past 15 years have consequences that are only now becoming visible. This awakening, still in its early stages, could drive sustained demand for precious metals independent of industrial fundamentals or monetary policy, simply because a critical mass of investors no longer trusts the paper promises that constitute modern finance. The road ahead for silver remains uncertain, but the crossing of the Maginot Line at $60 represents a threshold that cannot be uncrossed psychologically. Even if prices retreat temporarily due to profit-taking, intervention, or short-term demand softness, the market has now proven that the barrier can be breached. That knowledge changes everything. Technical analysts will recalibrate their models. Institutional funds will reassess allocation strategies. Producers will accelerate exploration and development. Consumers will seek substitutes or efficiency improvements. And investors worldwide will watch silver with renewed interest, recognizing that the soft default has begun, not with dramatic headlines or official announcements, but with the quiet, relentless erosion of confidence in paper promises and the growing demand for tangible assets in an increasingly uncertain world. The collapse of the Maginot Line was not the end of a story, but the beginning, the moment when the old certainties fell away and a new reality began to emerge, one where physical scarcity, monetary instability, and geopolitical transformation combined to reshape the landscape of wealth, power, and survival in the 21st century.